Welcome to Moneyman Investments. This is our monthly feature, State of the Markets, where we try to look at the market's internal data, do a detailed analysis of the same, and try and decode and convert all the noise that is going around into market signals. Let's see what this month holds, the month of February. This is what we do. We've done a lot of work in the investment advisory and assets management space. And I'm very excited to announce that very soon we should be coming up with 3 to 4 different products, mostly to be launched in the coming month, which will cover all different types of investors. So we'll go live, stay tuned for that. Anyway, let's jump back into our presentation. This is our quant market map. You all know what it is. We basically track 21 different quantitative metrics and try to decode what the market says. Now, I've just color coded this so that at a glance people can understand what is going around. As you can see, Feb started after a very negative note in Jan end. 1st of Feb had the budget. We saw a little bit of positivity, but after that, it's been a generally negative downslide in the markets on an overall basis. Feb, as it is a very, very negative month. I've already said this many times. Historically, it has always given very negative returns. And this month proved to be not much different from the historical perspective. Indices have been masking what has been really happening under the hood. Now, this shows Nifty 500, the top 500 stocks in the Indian markets and their performance over the last 1 month. You will see a lot of green, but don't get confused that, where is the green in my portfolio while the market is green? Because it is not. It is just the index and just the index stocks. A lot of buying has been happening in the index stocks. Some of them have gone up really well. However, on an overall market basis, the markets have generally been negative. So like I said, the indices, they've actually closed flattish for the month, but individual portfolios haven't. They've actually felt the pain, and we'll see this going forward. But of course, this just gives a picture about how things have been happening. And you can see that how IT has been really, really brought down in this particular month. But more on that later. So we closed Nifty 500 at 0.38%, which is very flattish. There's a lot of greens that you saw in the earlier slide. That is also Nifty 500. But on an overall basis, the market has been negative, as I had said earlier also. We are entering into, we are leaving a very negative month of February. We are entering into the month of March, which is usually much more volatile than the month of Feb. However, there is almost always a positive tinge to the entire month. The month of March is also very unique because this is when corporate India usually closes its books for the financial year. And there's a lot of churning that happens for HNIs, for individuals, for mutual funds, for everyone. So expect a lot more volatility, lot more volumes, which was actually absent in most of February. And I'm expecting that there'll be a slightly positive tinge after a very negative February. There'll be a positive tinge in the month of March. This is one of my favorite slides, and I've shared this with you all quite often. This shows average returns over the last 5 years, over the last 15 years, and over the last 25 years. For different months. And as you can see, February seasonally has been extremely bad. And we saw that coming in. It's always, like I always say, it's always good to be prepared for seasonalities in the markets and for probabilities in the market. When you know that things are going to usually not go in your favor in that particular time period, you know that you can reduce your activity. That is what February taught us, February told us, and that's exactly what we did. The month of March is a different ballgame altogether. From a generally negative Feb, you see a sudden spike and positivity coming in the month of March. Over a very long term, if you see, it's generally been a very flattish month. But for the shorter terms, it has shown a good positivity. And that is what I'm expecting for the month of March. Expect seasonalities to change. Let's leave the energies of February with February only. March is a new month, and let's hope for the best going forward. There are a few reasons to not cheer for that is negative reasons, but there are also a couple of very interesting aspects that are happening as we move into March. I'm going to cover those towards the end of this presentation. They are extremely important data points, and I feel that we are just on the verge of shifting everything. So more on that later. Coming back to February, let's look at how the month was. Mid caps outperformed the entire market. There was a lot of activity in mid caps, but otherwise we saw very high volatility and a flattish nature for all the other indices. For the calendar year, we are still negative on all the indices. However, mid caps caught up a lot in this particular month. But having said that, there is no real strength in the market right now. I would want to see strength in the market, which is denoted by this dotted line. So all of these metrics go beyond that. That is when we'll see real activity. So this has generally been a very slow, low grinding markets and grinding down with a negative bias. Not good. Not at all good, because on the face of it, you feel that indices are not moving, but portfolios are actually going negative. And that's what we saw in this particular month also. As far as breadth is concerned, there seemed to be some activity in terms of improving breadth in large caps followed by mid caps, while small caps have been left in the lurch. To be very honest, nothing much is happening, and that is the reason why you're seeing individual portfolios not moving, not really going up. In the last 5 years, individual portfolios, retail portfolios have got very heavily weighted towards small and mid caps. And if there is no movement happening in small caps specifically, individual portfolios just don't move. And that is what we are seeing right now happen in the market. Now let's look at overall markets. Like I said, there has been hardly any movement, and this particular data point shows that the overall breadth of the market has been extremely weak. We are seeing hardly any stocks which are above their crucial moving averages. Till this happens, we will not see things move in the market. And right now, that is exactly what we are seeing. It's a very listless, directionless, insipid market, but with a negative bias, which is not good at all. But having said that, there is a bit of positivity that I saw in February, just a tiny bit, where we saw the overall breadth actually increase or improve from January times. Of course, the end of January was quite beaten down in the markets. So it could be an impact of that also, because it tracks from the end of January to end of February. So while I'm caveating that, I'm also saying that there was a small improvement, and let's see if this holds on. However, if we look at the returns dispersion from an overall markets perspective, we saw a generally directionless market by looking at this particular metric. Stocks moving 0 to 5% and stocks moving 0 to minus 5%. Most of the market has been focused here only, concentrated here only, with a good sizable chunk also on this in this particular segment. Stocks moving minus 5 to minus 10%. Now, if you see, large caps have been the least affected. The dark blue ones are large caps, and on the negative axis, there's hardly any large caps that are there. Small caps, however, a lot of them. The same thing if you look at the right side, which is the positive axis, small caps are hardly participating in the positive movements. So you're seeing a market where it's overall dull, flattish, listless. Large caps are not moving down much. They are moving up a bit. Small caps are not moving up at all. They are moving down a lot. Now, do you understand the significance of why small caps are directly correlated to individual portfolios? Because this is exactly how individual portfolios are behaving. And if you look at pooled funds like mutual funds, you would see hardly any difference, because a majority of the market is directionless and not moving much. For a good market to be there, for a good bullish market to be there, we have to see a lot of stocks breaking out and making net new highs. However, we saw February going the other side only. Now, January was very negative. February started negative but improved for a bit. Remember, the trade deal also happened in February. the India-US trade deal. But after that, unfortunately, everything has been just going down south side. In fact, the last 10 days of February have been extremely bad. Again, in line with seasonality, but they've only gone bad. And in fact, the last day of Feb, the last trading day of Feb was extremely negative. The unique thing about all these days from almost Feb 19th is that they've all been on extremely low volumes, wafer thin volumes. There's been no participation really. So I would not give it much significance right now and see what March has to say. But having said that, we did see a lot of negativity in the second half of Feb. The advanced decline velocity index shows us how stocks are moving up, and we saw January come down quite a bit towards the end, and then things started improving a bit in February. That's why I said there were a bit of positive points in February, and we saw this recovering a little bit, especially this particular aspect. But most of Feb, see this, from 8th onwards, 8th of Feb onwards, it has been either stable or with a negative bias. So nothing much has happened in February. However, it is good to see that this is trending a bit up on an overall basis. Let's see how it happens in March. One of the main things to track is how stocks are vis-a-vis their moving averages. I've color coded this again for your benefit. Green shows the good bits, that is stocks which are above both their 4-week and 10-week moving averages, both of them extremely important moving averages. Red shows the percentage of stocks below both their very critical moving averages. And while we saw December and Jan expanding on the negative parts, February started with a bit of positivity. But again, from 8th onwards, it's only been a journey downhill. And we are seeing now more number of stocks which are below their 4-week and 10-week moving averages. What is the significance of this? This is usually an indication of a bearish market. And unless and until we see the green bits increasing, this market is not going anywhere really. Let's look at market health. We've actually been seeing the number of stocks away from their 52-week highs. That is, the closer the stocks are to their 52-week highs, we've actually been seeing them in very, very limited numbers. There's hardly any stocks that are there. While the number of stocks that are much farther away from their 52-week highs have been only increasing in the last 3 months. This is not a good sign for the markets. Not at all. I would want to see more number of stocks near their 52-week highs for a good bullish market to happen. We've not seen it till now. Jan and Feb have been extremely bad in that aspect. Let's see what March will bring in. This shows sectors and industries. Now, while the overall markets have been negative, there are always some sectors which do good. As I say, there is always a bull market somewhere. And this has happened in India also. We have seen some sectors which have shown extremely good movements. Of course, select parts in those sectors like autos, banks, etc., where things have been moving up in a good manner. And this shows how industries have performed. Now, this is not only retrospective data, we can also understand which of the industries and sectors are looking strong by looking at percentage of stocks above their moving averages and what percentage of stocks are near to their 52-week highs. As of now, that strength is being shown by banks and on an overall basis. And in Feb, it was the public sector banks that were showing a lot of that. See this. So let's see how this holds on for the month of March. But here you can identify which are the value points that could go up in the future. This is something new that I've started. This is sector rotation now. This shows which were the top 5 sectors for the particular month, which were the bottom 2 sectors for the particular month, and how did they behave vis-a-vis the market. It's a very unique market in another aspect. In the last 2-3 months, what I've been noticing is that sector rotation is happening extremely fast. Money flows in, stays into a sector for 2 to 3 weeks, maximum 4 weeks, and then moves out. See this. Uh, we see some sectors going up very well, and then in the next month they're just not there. PSU Bank is one aspect, as is gold, where it has stayed in the top 5 for now 2 months in a row. However, it's not been happening regularly, and money is just flowing too fast into and out of these segments. It's and that also shows it's a tough market, because it's not a trending market. If it were a trending market, money would keep flowing into one particular or a few particular sectors, and we would see leadership in that particular segment. Right now, we are not seeing that. IT has got beaten down, sorry, in a very bad manner, and digital, of course, also because a lot of overlap is there. And February saw the worst ever, where this entire segment got beaten down in a big way. Usually, when things become so oversold, they bounce back. Let's see how this happens in March. But right now, this is how sectors look like. This part is left blank, and we'll be populating it as the months come by. Investing styles tell us where is money really coming into? How are investors, the big investors, really behaving? And I'll take this data point to explain this to you in a better manner. There has been buying happening, but it has all been value buying, which is good stocks that have been beaten down a lot in this market. A lot of value buying has been happening. Momentum has just about started catching up in the month of February. It has been absent in the market since the past many months. However, value buying has been standard and has been there in a lot of way. The other aspects, the other investing styles haven't been working really in this particular market, especially growth investing. So all the investors that you see have only been value buying, and that is why you see this particular investing style go up in a big way. FIs, one of the most important or most talked about narrative in this market, they were positioned extremely negatively. In fact, they were carrying unprecedented index short positions. As you can see, the spike downwards in the beginning of Feb. They exited a lot of their shorts. However, we did not see a short covering rally. Usually when shorts are exited from this, the rally that follows in the market is huge. We saw nothing of it. Even though the US trade deal was announced and there was a huge gap up in the market, it did not sustain. And in fact, the same day, things only came down and became negative. We saw these net shorts decreasing, and again in the last few days, I'm seeing it increasing. Now we are again coming to a very high net index short positions carried forward by FIs. Again, not good, but the silver lining is that when these shorts start getting liquidated, that is when some good news starts coming in, there is a huge short covering rally that happens. It has not happened till now, does not mean that it cannot happen in the future. That is usually how markets are. When short covering rallies happen, you see huge buying come in, and indices and stocks start moving up when these shorts are covered. On the cash side, there were some rumors, this is on a monthly basis, there were some rumors that FIs have started finally coming in. However, that has not happened yet. We still saw net negative positions for FIs. They've been net sellers in the market only. While DIIs, the lower graph, they've been buying. However, much lesser than earlier. Now there's a very important data point that I want to use to debunk this entire theory of FI buying narrative. People look at daily and monthly figures for FIs, but let's zoom out a little bit and see what have they been doing on an annual basis. I'm taking data of the last about 6 years. Of course, current year 2026 is still going. You will see that FIs have generally been net sellers only. They hold a huge amount of positions, right? And they keep churning it. They've been net sellers only, while DIs have been net buyers only. And who are these domestic institutional investors? They are essentially mutual funds that use your SIP money to buy from the market. FIs continue to sell, they may continue to sell, we will have to come out of this narrative. Look at the other bit of it that is usually ignored. DIIs bought record amounts, probably the highest ever in the year of 2000, in the calendar year 2025, but still the markets did not cheer for it. The entire narrative is focused on whether FIs are buying or selling. This is a false narrative. Needs to be debunked. People have to come out of it because they are also investors. When they see that Indian markets are looking good, they will come in. However, there is huge volume coming in from DIIs. And looking at how the first 2 months have gone by, looks like we are again in for a record year. I think it's high time that people stop looking at only FI numbers. They could aid in the market, but they are not determinant of the Indian market's future. That it's an extremely important thing that people need to remember. Even in good market conditions, FIs have hardly bought. In fact, they've still net sold. So one can imagine how this FI narrative has come into the market and why it needs to be kept aside. Let's move away from all this noise. Like I said, I'm here to debunk a lot of these and convert that into market signals. Let's focus on what our markets are doing. Which brings me to the most important part of this presentation. How is the market going to look? How is the market looking like in the coming months for individual portfolios by looking at small caps? I've already put out a separate feature, which is called long story short, which is condensing a lot of analysis into a short bit. And there I've spoken about what is my small cap performance outlook for 2026. You can look at that particular feature for a slightly longer explanation than what I'm going to give you right now on this. But it looks like we are at a confluence of supports, which is here, which is this trend line that is moving up, which connects previous significant lows, and this horizontal line, which also connects previous significant lows for small caps. And we are resting right over there, and we are forming a reversal pattern. We have already kind of formed a reversal pattern for February to be confirmed in March. Now this needs to start going up, and we may see things to start improving. That is what I feel. Whenever things happen at a confluence of 2 or 3 things coming together, in this case confluence of supports here, usually the probability of that going forward and following through is much higher. That is why I feel that we are now poised for things to go up from here. However, small caps outperforming overall markets will be seen only once this green line is breached above. So this is how I expect the markets to behave going forward. This is, mind you, a ratio chart, not a chart of only small caps. It is a small cap to overall Nifty 500 chart. I expect the small caps performance to start going up from here, consolidate a bit, and then start moving up. And that is when we'll see absolutely rocking performance, which is exactly what I'm expecting from small caps in the coming months. There's another reason for that. This is not the only thing. Like I said, there's a higher probability of things happening when there is a confluence of a lot of things happening, and I'm obviously saving the best for the last. This is a small cap time scale analysis. I have split the overall markets from 2020 COVID lows into 4 separate segments, and you'll see a beautiful coincidence or a pattern emerging here. This is the COVID low. Follow my cursor. This is a COVID low, and this is the small cap chart on a monthly basis. This is a COVID low from April 2020 onwards. Don't mind the dates. It wasn't on 1st April, but this particular chart only shows the beginning of the month, and that's why you'll see all of these significant points as the first trading day of the month. From April 2020, we started a secular bull run, everything going up till about October 2021. This lasted for 18 months. The overall market actually started going down from there itself, from October 2021, and really started crashing down from December. But October is what I would take as the time when markets more or less peaked out, a period of 18 months. From that time onwards, that was the first leg of the bull phase. The upside, that is the trough to peak, was about 242%. And the overall on a closing basis, it was 198% on the small cap. Imagine that. And it was a fast up move. The time taken was 18 months. Then we started the first leg of the bear phase, which lasted 17 months, starting from October 2021 till March 2023. In fact, March 27th, 2023 is the exact date as I remember. We saw a grinding down move. It was very slow, it was very steady, but the peak to trough that we saw was 34%. That is absolute top to absolute bottom, while an overall downside was only 16% in this time period. The time period taken was 17 months. Then we started from March end 2023, we started the second bull phase leg, which, surprise, surprise, lasted another 18 months. 18 months, first leg, 18 months, second leg. The overall trough to peak for this was 126%, while the overall upside, that is on a closing basis, I'm so sorry for that, overall closing basis on a closing basis was 113%. The time taken was 18 months, just like the first phase, and this was a very fast up move. Things like really started going up. And then September 2024 onwards, we started the second leg of the bear phase. And surprise, surprise, we have just finished 17 months. 17 months here, 17 months here. Peak to trough was about 29%. And overall, it has been down only 12%. That is on the index level. Stocks have been down 30, 40, 50, 60% during this phase. Remember that. You can see the character change here. This was a very slow down move, grinding down. This was a very violent down move. So a lot of capital destruction has happened here. Good news, 17 months here, 17 months here. And it looks like we are also at a confluence of supports, as I explained in the last chart. So what is important to see here is that the month of March, which is the 18 month, that is 17 months are over now here, will the month of March take it going forward? I mean, take it up going forward. This is something that I'm expecting. Seasonality is aligning. The small cap outperformance to overall market is at a confluence of supports, and we are seeing a beautiful symmetry in the time scale analysis also. Looks like we are in for good times ahead, right? Let's wait and watch. I'll of course keep you updating on a regular basis. You know where I update you. It is on my WhatsApp channel. If you're already part of this, you know that there is a lot of value that is being added here. If you're not part of this, I urge you to come and join today itself. On a day-to-day basis, on a weekly basis, on a monthly basis, I post a lot of insights, a lot of relevant snippets. Try it for a week. If you don't like, you can always leave. It's free, of course. You can scan this code and you can be a part of that. I also will be releasing a lot of important information on that channel only. It's my preferred mode of communication. So very happy to see you there as part of the Moneyman tribe. So I hope this was of value to you. I hope your time seeing this presentation was well spent. Look forward to more of such instances. Thank you so much for your time.